You wake up in the morning on a random Tuesday. Nothing feels unusual. You follow your daily routine before opening your portfolio. Coffee? Checked. Markets open? Checked. $48 million suddenly appearing in your account. Not so much. Most people would think they'd hit the jackpot. Others would call their broker immediately. One trader did neither. Instead, he made a decision that would earn him millions, trigger a lawsuit, and force a court to answer one surprisingly difficult question: who really owns the profit? But before we get there, we need to go back to where it all began. He wasn't a billionaire. He wasn't a Wall Street hotshot managing billions of dollars. He was just an ordinary F&O trader in India. Like thousands of others, his days looked almost identical. Wake up, watch the markets, study the charts, look for opportunities. Hope today's decisions were better than yesterday's. Because that's what trading is. You're constantly making decisions with incomplete information, knowing that one good trade can make your week, and one bad trade can erase it. On this particular morning, he logged into his trading account expecting another ordinary trading session. Instead, he froze. His available trading margin had exploded. Not by a few $1,000s, not by a few $100,000, by nearly $48 million, or roughly rupees 40 crore. For a moment, he simply stared at the screen. Then he refreshed the page. Once, twice. The number refused to disappear. His heart started racing. Something's wrong. Had his account been hacked? Was this a software bug? Had someone accidentally transferred money into his account? Whatever had happened, one thing became clear almost immediately. That money wasn't his. Somewhere behind the scenes, a technical error at his brokerage had mistakenly unlocked nearly rupees 40 crore worth of trading power in his account. Not cash he could withdraw. Not money he could wire to another bank. Just buying power that should never have existed in the first place. Now most stories would end here. You report the mistake. The brokerage fixes it. Life goes on. This story didn't. Because sitting in front of him wasn't free money. It was something far more dangerous. Free opportunity. To most people, rupees 40 crore is simply an unimaginable amount of money. To a trader, it's leverage. A chance to place positions he could never afford with his own capital. Of course, there was a catch. If those trades went badly, the losses would be just as real. He had only a few moments to decide. Close the account, pretend he'd never seen the glitch, or take a chance that could change his life forever. He took a deep breath, moved his cursor over the screen, and clicked buy. The order was placed. There was no turning back now. Every second the trade remained open, he was risking money that had never belonged to him in the first place. It wasn't a lucky spin, or a random bet. He wasn't throwing darts at a stock chart and hoping for the best. This was what he did for a living. Every position, every entry, every exit, was based on years of experience reading a market that rarely showed anyone mercy. But experience doesn't guarantee success, especially when millions of dollars are on the line. The market moved, at first, not in his favor. Within minutes, his position was showing a loss of nearly $65,000, or roughly rupees 54 lakh. Just like that, the dream was beginning to unravel. Imagine the pressure. Not only were you losing money, you were losing money that should never have been in your account to begin with. One wrong move now, and this story wouldn't end in a courtroom. It would end in financial disaster. But he didn't panic. He didn't close the trade. He trusted his analysis and waited. Sometimes that's the hardest trade of all. Then, the market turned. Prices started moving exactly the way he had predicted. The red numbers slowly disappeared. Losses became gains. Thousands turned into lakhs. Lakhs became crores. By the time he finally closed his positions, the impossible had happened. In less than half an hour, the accidental 40 crore rupees buying power had generated a profit of around more than $2 million, or roughly rupees 1.75 crore. One ordinary trading day had become the most profitable day of his life. Except, someone else had noticed. Back at the brokerage, alarms were already going off. A routine technical error had accidentally given one client access to nearly 40 crore rupees in trading margin. The mistake was identified. The excess buying power was immediately withdrawn, and the brokerage demanded that every rupee of the accidental margin be returned. There wasn't much to argue about. The trader knew the 40 crore had never been his. He didn't try to hide it. He didn't disappear. He didn't claim ownership. The money went back. Case closed. Or at least, that's what he thought. because a few days later, another demand arrived. This time, the brokerage wasn't asking for the 40 crore. They wanted something else. The 1.75 crore profit. According to them, none of those profits would have existed without their mistaken margin. No glitch, no trades, and no trades, no profit. Simple. The trader saw it very differently. Yes, the opportunity came from a mistake, but the profit didn't. The trades weren't automatic. The market could have gone the other way. In fact, for a few tense moments, it almost did. Every buy, every sell, every decision, every risk, those were his. And if he had been wrong, the losses would have been his too. Neither side was willing to back down. What started as a simple technical glitch had suddenly become a legal battle over a question with no obvious answer. When opportunity belongs to one person, but the skill belongs to another, who owns the profit? Who was right, the trader or the brokerage? The lawsuit wasn't about the $48 million. That money was long gone. It had already been returned. The fight was now over something far more interesting. The profit. More than $2 million. Both sides walked into court convinced they were right. And honestly, both had a pretty convincing argument. The brokerage went first. Imagine lending someone a lottery ticket by accident. They scratch it. It wins millions. Who keeps the prize? According to the brokerage, the answer was obvious. Why should someone be allowed to keep money that only existed because of their error? The entire opportunity belonged to them, so the profit should too. Simple. Then came the trader's turn. He didn't deny the mistake. He admitted from the very beginning that the 40 crore was never his. That's why he returned it. The opportunity came from the glitch, but the profit didn't. The computer hadn't placed the trades. The brokerage hadn't told him what to buy or when to sell. Every single decision had been his, and so had every single risk. People often talk about profits. They rarely talk about losses. But the market doesn't care where your money came from. If his trades had gone badly, the losses would have been real. In fact, they almost were. Remember that $65,000 loss just minutes after he entered the market? That wasn't a computer error. That was the market doing what it always does, moving without anyone's permission. If the market had kept falling, there wouldn't have been a profit to fight over. There would have been a disaster. The trader wasn't guaranteed success. He earned it, or at least, that's what he believed. Soon lawyers on both sides were making their case. One side argued that the brokerage's money had created the opportunity. The other argued that opportunity alone has never made anyone rich. Because every investor is given opportunities. Not everyone turns them into profits. So what exactly was the court supposed to reward? Ownership, or skill, capital, or judgment? By now, this wasn't just a dispute over $2 million. It had become a debate about something much harder to measure. Was money enough to create wealth? Or did wealth only exist because someone knew what to do with it? Neither side was backing down. One believed ownership created the profit. The other believed skill created it. Now, there was only one opinion left that mattered. The judges. After hearing both sides, the courtroom fell silent. On the surface, the case seemed almost too simple. The brokerage hadn't disputed his trading skill. The trader hadn't disputed the brokerage's mistake. So surely, the brokerage would win, right? Except, that wasn't the question the judge was trying to answer. The 40 crore rupees had already been returned. Nobody was arguing over that anymore. The real question was much smaller, and much more difficult. Who owned the profit? Most people expected the brokerage to win. After all, it was their money. But then, the judge asked a completely different question. Did the brokerage create the profit? Because suddenly, the case wasn't about ownership anymore. It was about creation. The brokerage created the opportunity. The trader created the outcome. Those weren't the same thing. The market hadn't rewarded a software glitch. It had rewarded a series of decisions. Good ones, risky ones, profitable ones. And because of that, the court ruled in favor of the trader. He kept every rupee of the profit. Just like that. What looked like an open and shut case became one of the most fascinating legal rulings in Indian finance. Because think about it. If someone gives two people the exact same opportunity, do they both end up with the same result? Of course not. One might lose everything. One might do nothing. One might build a fortune. Opportunity opens the door. Skill decides what happens after you walk through it. That was the real lesson. The 40 crore rupees started the story. The 1.75 crore ended it. But neither was what made this case memorable. It was the answer to a question almost nobody had ever asked before. When success is created by both opportunity and skill, who truly deserves the reward? If you enjoy stories like this that don't usually make it into the spotlight, consider liking the video and subscribing. It really helps the channel, and I'll see you in the next story.